Welcome to our June 2023 market review. My name is Chun Siong and I am Providence Research Investment Analyst. To give an overview, there are 3 points we are going to cover. The first is that equity market had a great performance in June. Dimensional funds outperformed market indices as value and size premiums emerged. And lastly, year to date, equities and bonds had a good performance despite sobering headlines. Going into the first slide, the market index performance in June 2023. And the S&P 500, which reflects of the US top 500 companies, went up by 6.61%. The MSCI World reflects the developed markets, went up by 6.07%. MSCI All Country World, which reflects mainly developed and emerging markets, went up by 5.8%. And finally, the MSCI Emerging Markets went up by 3.9%. Well, this is despite the Fed signaling a 50 basis point increase by the end of the year. Now next, we look at the second slide, dimensional funds versus the market indices. Our dimensional funds actually outperformed the market indices in June. If you look at the chart, the ones with maroon colors are the dimensional funds, and right beside them is their comparable indexes. For our Dimensional Global Targeted Value Fund, it went up by 7.8% roughly, and for the MSCI World, it went up about 6.1%. That's almost a 2% outperformance. Next, if we look at the Dimensional World Equity, which reflects developed and emerging market, it went up by 6.34%, while the MSCI All Country World went up by 5.83%, about a 0.5% outperformance. Finally, if you look at the Dimensional Emerging Market Large Cap Call Equity, it went up by 4.31%, while the MSCI Emerging Market went up by 3.9%. So why is there an outperformance? Well, because there was an emergence of the size and value premium. The worries of a systemic banking crisis started to alleviate, and there was a sharp reversal in the US regional banks' stocks. And as a result, both the value and size premium outperformed, and therefore you see that the dimensional funds actually did better than our market indices. Before we go into the year-to-date performance of our portfolios, let us just go through the market events that has happened for the past 6 months. 2023 started off with strong gains in the market, but inflation concerns paired those gains. This is because of a strong labor market. Subsequently, a sharp rise in interest rate led to a few US regional bank failures. Notably, Silicon Valley Bank failed in March, and subsequently there was a failure in the First Republic Bank also failed in May. During the same period, Credit Suisse, plagued by many years of scandals, also collapsed. If you read these headlines, without looking at the market, you might think that the market is not doing well. That is not the case, right? We know from looking at previous slides, market has been quite positive. Why? Well, firstly, regulators and central banks took steps to shore up public confidence. US regulators, for example, assured Silicon Valley Bank's depositors that their deposits are safe. And in Switzerland, the Swiss National Bank provided liquidity to Credit Suisse to ensure that depositors' funds are safe as well. Furthermore, US companies actually had a very stellar performance in their earnings results. According to FactSet, about 80% of the S&P 500 companies actually beat earnings expectation. More importantly, the US mega tech companies actually had a very strong earnings results in both their top line revenues and bottom line earnings, which drove the developed market up. Next, we look at our funds, dimensional funds. Firstly, dimensional bond funds year-to-date performance as of June. Our global core fixed income fund, which have a comparatively longer duration, performed for the first half of the year, went up by 2.7%. For our shorter duration or shorter term bonds, like the Dimensional Global Short Fixed Income Fund and Dimensional Global Short Term Investment Grade Fixed Income Fund, went up about 2%. Well, this is despite that the Fed signaling an additional 50 basis point increase by the end of the year. Looking at our dimensional equity funds year-to-date performance, our Dimensional Global Core Equity Fund went up by 10.8%, our Dimensional World Equity Fund went up by 9.5%, Emerging Market Large Cap 7.5%, and finally, the Global Targeted Value went up by about 5%. Yes, the Global Targeted Value did not perform as well this year against the market indexes. But keep in mind that in 2022, Global Targeted Value actually went down much lesser than the rest of the market indexes, mitigating the downside impact in our clients' portfolio. If you look at January 2022, the peak of the market, till June 2023, our Global Targeted Value funds still outperformed the rest of the indexes. Furthermore, during this period, our Global Targeted Value has lower volatility compared to the other market indexes. By incorporating this fund into our clients' portfolio, we actually reduced the overall volatility for our clients and therefore providing a more positive investment experience to reach our clients' financial goals. Finally, looking at our portfolio performance, as we can see from our funds, year-to-date portfolio performance has been good. Now, taking an example, if we look at our Index Plus portfolio year-to-date performance, as expected, those with higher weight in equity tends to do better. Right now, indications have shown that market has shown resilience against a challenging economic environment. And keep in mind that the market is always looking for headlines to be apprehensive about something. Historical data have shown that in 21 instances since 1950, when the S&P 500 have rallied more than 10% for the first half of the year, of these 21 instances, there are 17 instances that the market continued to rally for the second half of the year, with an average return for the full year of about 25%. Now, we are not saying that the market will continue to rally. Now, quite the contrary. Market movements can be unpredictable. But empirical evidence have shown that market tends to go up in the long run. And by keeping our clients invested, we will be able to help them capture the upward returns and help them have a better chance of achieving their financial goals. Next, I'll be passing the time to my colleague Annette, who will be talking more about why we should be staying invested.
Thanks, Choon Siong, for the market review. Hi everyone, I'm Annette, Associate Advisor with Provident. So earlier on, as Choon Siong shared, in the month of June, the stock indexes all looked really good, right? Everything is up. And in contrast with February, you can see that most of the indexes were down. So if you had sold out in February, you would have missed the rally in June. And even if you sold out in February and subsequently went back to the market sometime in between February and June, you might have also missed out on some of the gains in June. Charlie Munger famously said, the first rule of compounding is to never interrupt it unnecessarily. So next, we're going to see what happens if we're going to interrupt this compounding, or what happens if we actually got out of the market. Okay, so over here, we are looking at hypothetical growth, okay, of $1,000 that's invested in US stocks and in specifically the S&P 500, okay, for the period between 1970 to 2020. So if we stay invested throughout these years, the $1,000 would have grown to become almost 121,000. Okay, but if we were to interrupt this period, okay, so if we miss the best performing day in the S&P 500, we would have made $12,000 less. Okay, and if we minus the 5 best days, we would have made $44,000 less. And all the way down, if we will have to miss the 25 best days, okay, we would have actually made $94,000 less. So as you can see, if we were to interrupt this compounding, we would have missed out on quite a lot of the earnings. So from this example, we can see that if your investment horizon is really long, like 20 years, then it makes sense for you to stay invested the whole way and don't be spooked by the short-term volatility in the market. That's all the time we have today. If you are keen to find out how we can help you achieve your financial goals, then please write to us or email us or call us. Thank you.